Okay, welcome to the second presentation in our online series, End Inflation and the Fed. I'm Jacob Hornberger, president of the Future of Freedom Foundation. Thank you all for tuning in, and thank you for your great support of FFF. As I wrote in my blog today, the federal government's debt has now exceeded $31 trillion, and there's no end in sight. That's part of the reason why President Biden obviously is hiring those 87,000 new IRS agents. They're going to try to squeeze more money out of the American people through income taxation. But we all know that's not going to be sufficient. And they're going to have to print the money. And that's to cover the excess and to pay off this debt. And that's where the Federal Reserve comes in. And we're very pleased to have an honored guest speaker today, Dr. Murray Sabrin. But let me first say, just as a matter of housekeeping, that if you want to ask a question, please do so with the Q&A button, not the chat button, but the Q&A button, and that question will come to me, and then I'll relay it to Murray. Also, Bart Frazier is going to be handling the PowerPoint presentations for Murray, so that will explain why Murray's calling for each slide to be passed on. So we're very honored to have Murray. Murray's been a good friend of mine for many, many years. He taught finance at Ramapo College for 35 years. He's retired now. When he was there at Ramapo, he had the most fantastic conferences and seminars, and I was able to participate in at least one, maybe two, I'm not sure, but the one I participated in that I recollect was just absolutely fantastic. He got his BA in history, geography, and social studies education from Hunter College, an MA in social studies education from Lehman College, and then a PhD in economic geography from Rutgers. He joined Ramapo in 1985. He retired in 2020, and he's written several books, two of which pertain to the subject tonight. One of which is entitled, you can get them both on Amazon, Why the Federal Reserve Sucks. And the other one is Navigating the Boom Bust Cycle, an entrepreneur's survival guide. In retirement, he's written several of these books. He certainly has not stopped working. And he's got an autobiography coming out shortly that is going to detail what has been really a fascinating life. He arrived in America from West Germany with his parents and his older brother in 1949. And his parents were the only members of their respective families who had survived the Holocaust. And Murray became a U.S. citizen in 1959, graduated from high school from the Bronx, and then, as I say, went on to get his BA, his MA, and his PhD. So without any further ado, it's a great honor and pleasure to have Dr. Murray Sabrin. Murray, take it away.
Thanks, Jacob. It's great to be with you and Bart. I've read your work for so many decades now. It's hard to believe that it's so long time that you've been ahead of FFF, and you're doing great work. And I wish everyone in America can read what you're writing, because it really rings true about what needs to be done to make America a free society again and a limited government republic. And I want to thank Bart for being my wingman tonight with the PowerPoint presentation. I recently read that people recall 80% of what they see and about 20% of what they hear and read. So that's one of the reasons I do a PowerPoint presentation. In class, it gives the opportunity for students to really see the data come alive as opposed to just talking about it. So without further ado, let's begin, Bart, with the first slide, which is a perfunctory slide. The boom bust cycle, is it different this time? And I will give you a definitive answer on that. Yes, it is different this time, and no, it is not different this time. So how's that for being a two-handed economist, on the one hand and on the other hand? So I'm going to get into the weeds, so to speak, of some of the key variables that highlight why we have a boom bust cycle. So let's begin with a basic proposition in the next slide. And the next slide, and this comes from someone that most people on this call should know about, the Zoom video. This has come from one of Murray Rothbard's wonderful little essays, The Case for 100% Gold Standard, where he outlines what a free market economy looks like. Namely, that production, and the production that I was in was an finance professor for 35 years. So I'm on the top there with Jacob, who provides educational and writing, and Bart, who does all his wonderful work for FFF, and other people who are working throughout the economy. They are all producers. And why are we producing? Because we have a passion for what we want to do. And for that, we purchase money. We purchase money with the effort of our labor, and that allows us to be consumers. This is the essence of a free market economy, and that production is based upon savings and investment. And so this is the free market economy at work. So you have to ask the question, where does the business cycle come in? Why do we have booms and busts? So the next slide will give us an idealized version of what an economic cycle looks like that we've been experiencing in the United States for many decades. The economy goes up, it reaches a peak, it declines, it reaches a trough, and then that process continues. But if you look at the trend line, the economy keeps on going up and up. So how do we know that's occurred? Well, the next slide really gives us that information from the Federal Reserve. This is the real GDP. In other words, taking inflation out, real GDP has gone from $2 trillion in the lower left side after World War II to $20 trillion today. And those vertical gray lines show us the recessions that have occurred. So this is the real economic cycle, not the idealized one. And what we notice, if we had this chart going back to 1920, what is kind of interesting, and I don't know the explanation for it because I don't think there is an explanation, every year beginning in zero, except for 1 year, and I'll explain that in a second, has been a recession year. 1920, 1930, 1940, even though it doesn't show that on the chart. 1940 was still part of the Great Depression. The economy was still, if it wasn't contracting, it was still growing very slowly. 1950, 1960, 70, 80, 90, 2000, and the 2010 recession happened earlier with the housing bubble in 2007 and 8. And in 2020, we didn't have a typical business cycle downturn, even though the economy contracted for a very short period of time. That was caused by the lockdown. That was the COVID implosion that occurred. And so the question is, what will occur in this decade? Well, I'll get to that during the presentation today. So the next slide gives us the optimistic viewpoint, which comes from Warren Buffett, that don't bet against the U.S. economy because the economy has grown magnificently since 1776, the founding of the country when we declared our independence. So Buffett's quote, I think, should give us some optimism that despite everything we have, the military-industrial complex, the welfare-warfare state, the foreign interventions, the economy keeps on growing. And I explained that in the next slide. In my book, the Navigating the Boom Bust Cycle, I think I'm the only economist who has done a SWOT analysis of a free market economy and a mixed economy. And I do that by showing what are the strengths of the free market economy, which we all know. It creates prosperity. What are the weaknesses? Well, I don't know any weaknesses, but the critics say the weaknesses are that it's unequal. There's not enough equity. In other words, not capital equity, but equity in terms of outcomes regarding income. So that's what the weakness would be, according to the critics. Opportunities abound, and the opportunities in the free market economy are just endless. You look at all the entrepreneurs in the last 2 years during COVID, how they repurposed their businesses to survive. And that's something I discuss very frequently in my book. And of course, the mixed economy, Austrian economists have been writing about the weaknesses of the mixed economy for decades. In fact, Mises, Ludwig von Mises, sort of the father of the Austrian school in the 20th century, talked about how the middle of the road policy leads to socialism, a great essay that you should all read, available at the Mises.org website. So all this information, the real detail is in my next book. So the next slide will give you the cover of Navigating the Boom Bust Cycle, which came out exactly a year ago, October 5th last year. And I think this book is timeless because it goes into the history of the business cycle, the SWOT analysis, and how entrepreneurs whether you're a mom and pop business, whether you're the CEO or CFO of a small public company or a large company, how you can navigate the boom bust cycle. So it gives practical advice. So when people talk about Austrian economics being theoretical, what I've done in this book is take the theoretical components of Austrian economics and show how it can be applied in the business world, how entrepreneurs can use Austrian business cycle. I don't call it theory, I call it the business cycle explanation, to give entrepreneurs sort of a heads up and how they can not only survive, but thrive during the next upturn in the economic cycle. So in the next slide, what we see very simply is why do we have the business cycle? If the free market provides us with economic and social harmony, why do we have the economic cycle? Now, we don't know who originated this quote. There have been various theories that it could be Mark Twain or some other people. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. And if you recall the movie The Big Short, that's how the movie started, with that quote. And I think it speaks volumes about the economics profession. For decades, they've been telling us that the free market is unstable, that the Marxists will say that we need communism or socialism to make sure that we don't have these cycles. And of course, the Keynesians will say that we need to manage the economy through fiscal policy and monetary policy. In other words, a form of soft central planning. So if we go to the next slide, we get some information from Robert Murphy, one of the top Austrian economists in the country, about what the business cycle is all about. This, I think, is a beautiful quote, because what it does, it is a succinct quote of the Austrian explanation of the business cycle. When the Federal Reserve artificially reduces interest rates below their free market level, it sends a false message to entrepreneurs. Firms begin expanding as if consumers have increased their savings, but in fact, consumers have reduced their savings due to the lower interest rates. Businesses that churn out durable goods, such as furnaces, cargo ships, and yes, houses, will find business booming because these sectors respond positively to low interest rates. This is in a nutshell of what Mises talked about in his work in the first half of the 20th century, and his students Hayek in the 1930s and Rothbard and others in the post-war period have been writing about for decades. And of course, last week, Richard Ebeling has been writing about this for decades as well. And this gives us a starting point. If you reduce interest rates artificially, and the analogy I like to use is, if you take a beach ball being interest rates and you see it on a lake or the ocean where it's calm, the beach ball will sort of bounce around but won't go up and down. But if you take the beach ball and put it underneath the water, that's not where the beach ball's natural position is. What's going to happen when you release your hand? The beach ball is going to go up. So by the beach ball going below the waterline, that's what the Fed does to interest rates. Put it below its natural level, and then when you let it go, it goes up to artificially high levels where it shouldn't be. But that's the essence of the cause of the business cycle, the manipulation of interest rates. So Robert Murphy did a wonderful job in describing this in a very succinct paragraph. So the next slide gives us another great quote from Mises. The ultimate cause of the phenomenon of wave after wave of economics ups and downs is ideological in character. The cycles will not disappear as long as people believe that the rate of interest may be reduced, not through the accumulation of capital, but by banking policy. So by banking policy, it's a combination of the Federal Reserve and the banks. If you remember your financial or economic history, we had business cycles before the Federal Reserve was created. And what were they called? Banking panics. They were banking panics because the bankers issued paper money in excess of the gold that they had in reserves. By keeping funds available to the public without backing by gold, they created a little boom in their economy. And one of the earliest books on this is Murray Rothbard's doctoral dissertation, which was published in 1962, The Panic of 1819, which is considered by many the definitive work of the first great panic, banking panic in the United States. And it's available to read at the Mises.org website. A wonderful, wonderful book I used in my financial history class for students to understand how the banking panics began in the United States with bankers issuing excess credit. Of course, the the second bank of the United States also was responsible for this as well by issuing additional credits as well. Now, let's go take an up-to-date quote on the business cycle on the next slide. And this comes from a wonderful book by Bill Fleckenstein, Greenspan's Bubbles, The Age of Ignorance at the Federal Reserve. And this, I think, sums up what Austrians have been saying for decades, but he does it in a way that the average person, I think, can understand it much more easily than the nuances of the Austrian cycle. Central bankers are actually central planners. They pick an interest rate to within 2 decimal places they guess is the right one, and they then proceed to cram it down the throat of the banking system. This, I think, is another succinct quote of how the Federal Reserve manipulates interest rates, which is, after all, the price of money. To put it in a nutshell, it's really the price of time, but it's expressed in money, with the interest rate expressing the supply and demand for credit in the marketplace. So interest rates should be a free market price. There shouldn't be an intervention in the credit markets to determine what some people think the interest rate should be. And the next slide shows us how the Fed funds rate, which is the interest rate that the Federal Reserve has an impact on by its buying and selling of securities through open market operations. And again, on the left-hand side, you see from the early days of the 1950s and 60s, it took 40 years, thereabouts, 35 years, for rates to reach incredible heights in the crisis of 1980-81, where rates went above 20%. That's the Paul Volcker era, where he put a squeeze on the money supply and drove up interest rates to knock the double-digit inflation out of the system. And then rates started coming down for 40 years. But more importantly, you can see where it says 2000, that rates collapsed after the dot-com bubble. That was the Greenspan Fed. And they kept rates well below the rate of inflation. And then the Fed started increasing rates very incrementally to stop the overheating of the economy in the 2000s. And then when the financial crisis hit, the Great Recession, rates came down. And look where they stayed. They stayed at close to zero for about 8 years. And then under Bernanke and Yellen, rates were increasing very, very slowly. And then Powell came in, and look what Powell did. The economy was still expanding, and he lowered interest rates in an expanding economy. That never happened before. So that's why this cycle is a lot different than previous cycles in that aspect. Then he kept rates down during the panic of the COVID panic. And look what's happened recently, all the way on the right-hand side. They've raised interest rates very quickly, very dramatically. And the question that people are asking is how high rates will go in the future to stem the 8% inflation that we now have. And I'll have a chart to get into that a little bit in the presentation. So here we have the Fed pumping money in, pumping money out, manipulating interest rates to try to get it right in terms of what the rate should be. So Fleckenstein's observation is spot on given the history of the Fed, especially since the dot-com bubble burst in 2000. So the next slide gives us the most recent Fed funds activity of the Federal Reserve. Again, this takes the last few years of the Fed's manipulation of interest rates and shows you how quickly rates can go up. And rates peak just before the recession begins. You can see that in 2000, rates peaked, then they started coming down. Rates peaked before the Great Recession. And then rates peaked before the COVID implosion. Now the question is, when will rates start coming down? And that will tell us that the recession will get deeper. Right now, even though the first 2 quarters of 2022 have been negative, which is the technical definition of a recession, I don't think we're there yet where we have the implosion of the economy due to the bust of the business cycle. And we'll get into that in a little bit, and I'll show you why I think that we still are a few months away from the downturn really taking hold. So we go to the next slide, and what do we see? This is how the Fed achieves its objectives. This is the assets that the Fed owns. And if you look at 2008, the Fed had about $800 billion worth of assets on their balance sheet. Then during the Great Recession, they increased it to $2 trillion plus. And then it started creeping up. And then in 2013, it really went up and stayed at the $4.5 trillion level. Then it started to wind down. And then look what happened as COVID hit. We went from under $4 trillion to $9 trillion. The Federal Reserve created $5 trillion out of thin air. That is a mind-boggling number. Remember, it was only $800 billion at the beginning of the Great Recession. So that means the Federal Reserve created $5 trillion in a short period of time, when in its 100-year history, it only created 800 billion. So for some people, this means that hyperinflation is a real possibility unless the Fed deflates its balance sheet and starts to bring in the money supply. And we'll see that there are two things happening here. One is the Fed's balance sheet is still bloated. It's still well above its pre-COVID high. The question is, how quickly will the Fed get its balance sheet down? And if it does, then I think we could see a massive deflation in the economy, or we could see stagflation. So those are the two possibilities going down the roads. So when we go to the next slide, we see the M2 money supply. This is the broad measure of the money supply that some analysts use. And you can see what happened during COVID. The money supply just skyrocketed to over 25% on a per annum increase. And of course, it's come down quite a bit, where now it's increasing only at 5%. And that correlates nicely, as we'll see, with the stock market as well. So when we go to the next slide, we see this. If some of you who are the followers of the late Robert Wenzel's work, this is something he published in Economic Policy Journal. He used to publish this on a weekly basis in his daily investment or financial newsletter. And what he did was he took you can see it at the bottom, the 13-week annualized, not seasonally adjusted M2 money supply. And he was the only one, I believe, in the country that was using this. And he would take the data every Thursday evening, and he would have his associate calculate what the money supply, how the money supply was growing. And I don't have the data here from 2008. This is the most recent one. His associate has kept up since Bob died a year ago last May. And you can see that pink line in the middle of the chart. The money supply at one time was growing at 60% at an annual rate. And then the Federal Reserve officials are wondering why inflation skyrocketed last year. When you increase the money supply at 60% annual rate, that money has to go somewhere, and it goes into the economy, it goes into financial markets. That's what gave us the stock market boom over the last couple of years, which ended in January of this year. But look what happened. If you look at the magenta line, or the teal line, that stops at week 23. That's the 2022 M2 money supply growth. And look what's happened. It's decelerated markedly. Now that correlates with future inflation and the stock market and the economy. So what the Fed is doing is slowing down money growth, and that's going to have a huge impact. And it already had a huge impact on the stock market. The stock market's down, the S&P 500 is down 25% this year. The economy is getting weaker, and it's probably going to get a lot weaker into 2023. So this is the contribution of the late Robert Wenzel to our understanding. Now, the Fed used to publish this data weekly, and Bob's work, he told me, was read by a lot of people in DC. And so the Fed may have gotten wind of his data collection. And then early in 2021, they stopped publishing this data weekly and started publishing this data monthly. So this is not exactly transparency by the Fed as to what the money supply is doing, which is crucial to understanding how the economy is going to unfold. So when we get into the next slide, we see what the Fed did since the Great Recession. They paid interest on excess reserves, which is the first time it did that in history. So instead of the banks lending out the money and credit that the Fed was creating, it kept it in reserves at the Federal Reserve and earning interest. So that's what dampened inflation for several years after the Great Recession, even though the Fed threw so much money into the economy, dampening the rise in prices. Okay, and the next slide, we get into what are the dynamics of the boom-bust cycle. And here there are a lot of charts that that reveal how the economic cycle unfolds over time during the boom and the bust. So we start with the next slide will show us what people consider one of the best predictive tools of an impending recession. That is the inverted yield curve, where the 2-year Treasury note is higher than the 10-year Treasury note. So short-term rates are above long-term rates. That's the inverted yield curve. And if you look at this goes back to the 1970s. You can see that every time we have an inverted yield curve, it portends a recession. Now, we didn't have that occur in 2020 or late 2019. So that's why the implosion of the economy in 2020 was not a typical business cycle downturn. But now we have that occurring. The 2-year has gone above the 10-year. And so people think that a recession is, if not already here, is imminent. However, the next slide, I think, is a better predictor. And that is the 10-year versus the 3-month Treasury bill, which is influenced by the Fed funds rate. And lo and behold, what does it show? That we don't have an inverted yield curve between the 10-year and the 3-month Treasury bill. So this chart shows us very clearly that when the 3-month goes above the 10-year, which happened in before the 1990 recession, the 2000-2001 recession, the Great Recession, and it happened right before the COVID downturn. We're still not there yet. So that's why I believe that the downturn that if we're experiencing it has been relatively mild. And we just ended the third quarter of 2022. So let's see what the GDP shows. It could show that we aren't in an economic contraction, but in fact, the economy may have expanded in 2020. And we know that there are problems with the GDP because it measures government spending. So if government spending keeps on bobbling along here, that's going to impact the GDP numbers. So I'm of the mind that a full-blown recession is down the road. In fact, last December, I wrote a piece for Fortune magazine before 2022 unfolded. And I said, given the Fed's history, I think the recession won't begin until 2023, definitely by the second half of 2023, but I wouldn't be surprised if it happened sooner if the Fed is very aggressive in raising interest rates to stem the 8% inflation that we now have. So the next slide shows us the consumer price index. And what it shows us very clearly is from the mid-1960s, which you can see in sort of the left-hand side of the chart, about a third way in. Inflation during the Kennedy-Johnson administration was running about 1-2%. And then what happened in the mid-60s, 65, those of us that remember, the Great Society, Medicare, Medicaid, and the Vietnam War takes hold. And spending goes through the roof, and the Fed keeps pumping money into the system, and inflation starts taking off, and we get 3 peaks: the 1970 peak, the 1973-75 peak, and the 1979 peak. And then we've had this inflation for the last 40 years. And look, lo and behold, what do we have now? Inflation has skyrocketed so quickly and so high in a short period of time. This is different about this business cycle, that inflation has taken off like a rocket, not surprisingly, as the money supply grew by over 25%, the M2 in 2020. So here we are in 2022, and we're seeing the effects of the Fed's policies during the COVID year. So for the Fed to scratch their heads and figure out, why do we have inflation running at these hot levels when we thought we're doing everything right? Well, they're not doing everything right, and we'll see this in more charts as we go along. So this is the consumer price index. So the next chart will give us another indication of why this cycle is different than other cycles. If you look at the middle of the chart, the blue line is the 3-month Treasury bill, and the red line is the inflation rate. And what do we notice? In the late 70s, early 80s, interest rates were above the rate of inflation. In other words, we were getting a real return on our Treasury bills, money market funds. I remember in early 1961, I was getting 16% on the money market funds while inflation was running at 12%. So we were getting a nice real return. And throughout the 80s and 90s, interest rates were above the consumer price index, which is the red line. Now look what's happened in the last couple of years. The inflation rate is above the treasury bill, which means we're getting a negative return on our savings. In fact, I checked my money market fund at my bank this morning, and guess what the interest rate is on a money market fund? 0.02%, virtually zero, when treasury bills are yielding 3 to 4% right now. So we are getting basically nothing from the banks for lending them money, and they're giving us nothing in return. So this is turning corporate finance on its head. It's turning economics on its head, that the Fed is repressing short-term interest rates, because we should be getting at least 6, 8, 10% on our interest, like we did back in the early 80s when interest rates were above the rate of inflation. So the Fed has done something that has transferred, according to one article I saw recently, $4 trillion of interest income that we didn't earn over, that the American people didn't earn over the last 10, 15 years, from low income and middle income savers to Wall Street. And this is the shocking phenomenon that's occurred, and no one is talking about it. AARP is not saying how their members who are retirees living on fixed income, maybe on CDs and on money market funds, are getting really the short end of the stick. This probably, to me, is the most scandalous event that's occurred in American financial history, that if you have, let's say, $100,000 in a money market fund in a bank and you're getting zero interest rates and inflation is running 8%, that means you're losing 8% in purchasing power. That's a capital loss. I wrote one of my congressman's associates and said he should introduce a bill in Congress called the Savers Protection Act, that if you're getting less than the rate of inflation in your money market fund, you should be able to deduct that as a capital loss. I mean, that to me is something that members of Congress can do very easily. The Savers Protection Act that would put the Federal Reserve on notice that what they've done is really one of the greatest scandals, if not the greatest scandal in American financial history. So this chart to me spells why the Federal Reserve should be ended, because it is doing a great disservice to the American people. And that I think is a great understatement. So let's go to the next chart. This is the producer price index, and of course it has various components to it. It just shows you how it fluctuates during the course of a cycle. It goes up, it goes down, and reflects the supply and demand in the commodities market, and also the producer goods market, intermediate goods market, and finished goods market. So you have to disaggregate this to see where the pressure points are during the boom bust cycle. So when we go to the next chart, we see how the new money from the Federal Reserve is transmitted to the economy. And Murray Rothbard wrote about this, and other Austrian economists. It's through the banking system with their commercial industrial loans. And you can see it increases during the boom cycle, it contracts during the cycle and right after the cycle, as businesses don't need as much credit in order to sustain their businesses. And then look what happened since the Great Recession. It just went, it just skyrocketed. Of course, it contracted during the COVID situation and has started increasing again. So this is the transmission mechanism of how money goes from the bank, from the Fed to the banking system to the real economy. Okay, next slide. And this is the percentage change in commercial and industrial loans. And you can see the contraction during the Great Recession. It just collapsed as it collapsed during the COVID period. So it just shows you the volatility in this section of the financial sector. Okay, next slide, please. Now here is an interesting chart that everyone follows, the unemployment rate. And if you see, this is a pretty predictable chart. The unemployment rate declines dramatically during the boom phase of the cycle, as you can see in the white shaded areas, and then it bottoms out, it bases out for months, as we've seen in previous cycles. And then during the recession, obviously businesses are laying off folks as the recession unfolds, and then it reaches a peak. And you can see the spike in unemployment rate during the COVID panic. Now the unemployment rate has declined again. the first Friday of every month, the Fed announces the unemployment rate, how many jobs were gained, how many jobs were lost. And last Friday, they announced that the unemployment rate's down to 3.5%. That's why I think we're still not in the beginning of the recession. If we are, it's really the early stages of the recession. So as this unemployment rate starts to increase, we will start to see businesses winding down their staff, individuals reducing their spending, employers, companies reducing their capital investment, and then we will be in the full-blown recession. So I think this is on the horizon. So when we go to the next slide, we see job openings. This is what's interesting about this cycle. Look at the job openings. It's almost 12 million. Actually, it's gone down recently to 10 million. So there's plenty of jobs out there. You don't need an increase in the minimum wage to hire people. Companies are offering $15, $17, $18, $20 an hour plus bonuses to start. So the minimum wage laws are really irrelevant in today's economy, as employers have a hard time filling slots for jobs. As this number goes down, that means we will be in a full-blown recession, as we saw in the Great Recession of 2007, 2009. So the next slide gives us some more insight about the economy, and that is housing starts, another sensitive indicator for the business cycle. And you saw what happened during the housing bust. It just collapsed. Housing starts literally collapsed from 2.3 million down to about 450,000. I mean, it was just total wipeout. And of course, the prices of the housing stocks of publicly held companies, they collapsed as well. Some of them were down 90% in price. And of course, since the cheap money of the Powell era and Janet Yellen era, but prior to him, housing starts have rebounded. So we go to the next chart. This is a similar chart as housing sold, new family houses sold. So that's basically a mirror image of that. But again, this shows you even we've gone from 1.4 million prior to the great bust of 2008 to just under 300,000. Excuse me. So again, this shows you how the housing bubble was probably the greatest bubble in U.S. Economic history. Okay, the next slide. Here is a really interesting chart, not only from the point of view of the business cycle, but the point of view of the structure of the U.S. economy. This is the Industrial Production Index going back to 1920. And we had several recessions in 1920. Of course, the Great Depression should be the whole decade of the 1930s, even though the economy was, quote, growing a little bit in the 1930s, but we still had very high unemployment throughout the 1930s. And we see industrial production following the same pattern of boom and bust. However, since 2000, industrial production has been basically going sideways, which means that there's been a structural shift in the U.S. economy from manufacturing to more service-oriented jobs. And that's the whole gig economy since the dot-com bubble burst. The jobs are in everything from logistics to supply chain management, and we're doing less and less manufacturing here at home, and it's going overseas. But I think we may see a renaissance as the geopolitical events unfold, that companies may be very wary of having their production facilities overseas. Time will tell. So when we drill down in the next slide, which is even more interesting, this is the manufacturing index of the industrial production component, and what does it show? Manufacturing has not regained its size from 2008. Again, showing the decline in the manufacturing base of the United States. Of course, this doesn't mean the non sequitur that we should have protectionist economic policies or an industrial policy or subsidies to manufacturing. It just shows you how economic policy here at home has affected manufacturing. So the next slide will give us some more indication as to what's happening with easy money. This to me is another way of that easy money gets into the system. This is margin debt, where people buy stocks on margin. They borrow money The margin requirement now is 50%, so you can borrow, if you spend $10,000 on a purchase, you can borrow $5,000 from your broker. And you can see how closely it correlates to the stock market. So this is the fuel for the stock market, some of the fuel for the stock market, people buying on margin. And you can see when the stock market peaks, margin debt peaks as well, and then it declines, especially during a recession. So since it's declining now, as the stock market has declined since the beginning of the year, a recession should follow in the not too distant future if it's not already here. Okay, so the next slide. Here is something that in doing the research for my financial history class, there's an interesting development in the US financial history. Look at the panics. 1792, the first panic that Alexander Hamilton was Secretary of State, he quote, fixed it by basically engaging in open market operations, but that's a separate story. But look at the panics, 1792, 1893, then of course 1994 and 97. That was the Mexican situation and the Asian crisis, 100 years apart roughly. Then we get the panic of 1819, the forgotten depression of 1920, and the COVID implosion of 2020, 100 years apart. The panic of 1873, the first oil crisis of 1973. The panic of 1907, the housing bubble of 2007, 2008. Then the granddaddy of panics and the depression, the Great Depression of 1929. Does that mean we're going to have a depression in 2029 if this pattern follows? I have no explanation for this. I'm just pointing out what's occurred throughout American history, that every 100 years, and if we go back, by the way, from 1792, we go back to let's see, what year is that? 1720. So from 1819, we go back to 1720. That's the South Sea bubble, as one analyst pointed out to me. So there seems to be this 100-year cycle that I have no explanation for. I don't think there's an explanation, but it's just kind of interesting that from a time we have some of these great financial events occurring, great not because they're good, great because they're widespread and have a huge impact on the economy, that 100 years later we have something similar. So that's kind of interesting. So the next chart gives us some other interesting developments. This is a chart that Tom Bowley, who writes over at stockcharts.com and has his own newsletter, he's been analyzing stocks for decades. And he pointed out in one of his blog posts that there seems to be this long-term cycles in the stock market. That is, when the stock market peaked in 1929, we basically had stagnation for about 20 years. Then in other words, a secular bear market, a long-term bear market, where you had ups and downs, but basically the market went nowhere. Then you had this great bull market from the end of World War II to the late 60s. Then the market went sideways from the stagflation of the 1970s. Then in 1982, the market took off for 18 years until the dot-com bubble peaked in 2000. Then we went sideways again till 2013. And then Bowley suggests that we're now in another secular bull market. What we've had since the beginning of the year, he considers a cyclical a bear market. And so if you take the cyclical or the secular bull and bear markets, you add on 18 years to 2013, you get to 2031. So that's his analysis from a long-term perspective of how these bull and bear markets, namely booms and busts in the stock market, have occurred since 1929, which I think is fascinating. Okay, the next slide. This is something that another analyst came up with. This is Tom McClellan's work, which you can find on stockcharts.com also, and he published this several years ago. And he was doing some long-term analysis of the stock market and commodities markets. And he noticed that the trend of the price of oil and the stock market look very similar, except 10 years apart. So if you look at the Dow Jones peaking in 1929, the price of oil peaked roughly 10 years earlier, 1920. And that pattern seems to follow, not exactly year to year, but very close in proximity. So he's suggesting that the price of oil leads the stock market by roughly 10 years. So what does that mean for the current situation? Well, the stock market, the price of oil peaked in 2008, if you recall, at $140 a barrel. And then we had a stock market decline in 2018, toward the end of 2018. So that would be confirmed the most recent. Now he's showing that the price of oil declined in 2014. So he wrote as an addendum to this chart that whoever's in the White House in 2024 will not fare so well because we should have a downturn in the stock market in 2024. So again, that's his forecast based upon this one lead indicator, the price of oil in the stock market. And again, he doesn't have an explanation for it. He just shows that there's a correlation, a 10-year correlation, a lag correlation between, or lead correlation between oil and the stock market. And the other thing he shows is that the price of oil declined in 2020, which happened during COVID, which means the stock market should decline in 2030. So when you add everything up, is a good possibility at the end of this decade, we may see a substantial decline in the stock market and the economy based upon these long-term trends. Again, what are the explanations? That remains to be seen. So we'll see what happens at the end of this decade. In the meantime, we have to worry about what happens over the next 6 months, a year, if you're an entrepreneur or self-employed or working for a large company, what's going to unfold. So the next chart gives us something else to contemplate, and that is the book that was published 3 years ago, Why the Federal Reserve Sucks. And I have a chapter there on Ben Bernanke and his tenure at the Fed. And I just want to read you one quote. He just got the Nobel Prize today in economics. And I quote him at the beginning of chapter 3. And he said this in 2002. And supposedly he's a very smart individual given his contributions to economic history. And this is what he wrote before he became Fed chairman. Can the Federal Reserve or any central bank reliably identify bubbles in the prices of some classes of assets such as equities and real estate? And if it can, what, if anything, should it do about them? So again, in my chapter on Bernanke, I pointed out when he was testifying in Congress, he really didn't understand what was unfolding in the dot-com bubble, or what unfolded there, and what unfolded in the housing bubble where when he was there. So again, it's kind of interesting that mainstream economists still don't understand bubbles when Austrian economists have been talking about overvalued asset prices for decades. And it's just unfortunate that we still have to deal with these boom-bust cycles. So I think the next slide, if there is a next slide, and that's it. So that's what I have to offer, and my two books really go into much greater detail of the boom-bust cycle and how entrepreneurs can learn what information they can glean from the Federal Reserve to help them manage their companies better. And with that, I think we hit right on target, Jacob and Bart.
Yeah, you did absolutely great with respect to timing. We've got one question, but let me ask you a couple questions before we get to that.
Yeah.
On the boom bust cycle, one of the critiques has always been that it's when the money is injected into the money supply, it's not an equal thing. It's some people get it first. Can you talk a little bit about that aspect of this?
Yeah, this is great. In fact, my dissertation was about this 40 years ago at Rutgers, and Murray Rothbard was an outside member of my dissertation. And I looked at it from a geographic perspective. We know that the big banks are the recipients of the new money from the Federal Reserve. And so where are the big banks located? New York, Chicago, Los Angeles, San Francisco, Atlanta, the big city banks. They get the new money. They have more reserves. They can lend it out. So the businesses in those geographic areas are the first recipients of the new money, and they can spend and bid up the price of labor, the price of commodities, the price of capital goods. And of course, people on fixed income, public employees, minimum wage workers, their wages don't go up commensurate with the increase in the money supply. So their prices go up over time as the new money filters through the system. And we know their real incomes go down over the cycle. So unless you're either an early recipient or in a business that is a beneficiary of the spending of the new money, you're going to be lagging behind. And of course, the data from the last year shows that the average wage went up 5%, while inflation was up 8% for the average American worker. But given that we're such a high-tech economy, People are getting bonuses to sign. $100,000 salaries are not unusual for college graduates or people out of college for a few years. So there's a lot of great economic activity occurring. And I discussed that in my Boom Bust book of all the great businesses that have been created the last 30 years because of innovation and entrepreneurship has nothing to do with the Fed and Washington's largesse.
Okay, second question is that when I discovered libertarianism, one of the most shocking aspects of my discovery was to learn that the Great Depression was not the failure of America's free enterprise system. And you mentioned that Rothbard had been one of your dissertation advisors, which is quite amazing because I don't think very many people can say that. It's very impressive. But would you just talk a little bit about the Federal Reserve and the Great Depression aspect of this thing?
This is terrific because back then, Irving Fisher, the head of the Monetary School of Thought, said that we got to keep prices stable. I mean, why prices stable? Why should prices be stable? We know in a free market, and Rothbard and others wrote about this, in a free market, prices slowly deflate, as we saw in the post-Civil War period, where we had gentle deflation, and that increased the living standards of workers as their wages stayed the same and prices came down. And of course, their costs go down, as Rothbard pointed out. And so that's the beauty of the free market. Jacob, I realized that in the 1950s when color television was introduced in the marketplace, and I was a youngster in elementary school, and I said, who buys a color TV when it's $1,000? Let production gear up and prices will come down. That's exactly what happened. And so I've always believed that prices should come down. Then I started reading Milton Friedman. He said, no, prices have to be stable because when the Fed increases the money supply at 3% a year and the economy grows at 3% a year, prices are stable. So Friedman had an anti-market view of the economy that prices do come down, as we've seen for a whole host of products the last 20, 30 years because of productivity. And this is what the Fed didn't allow to happen in the 1920s. So when prices were stable in the 1920s, most economists said there's no problem. Prices are stable, the stock market's booming, real estate is booming, it's great. And then what happened? The Fed got worried about the overheated economy, and instead of allowing the free market to lower prices, they kept prices stable and elevated, and that money went into the stock market and the real estate market, and the great crash occurred. And Hoover, as we know, did everything wrong, as Rothbard points out in America's Great Depression book. The Fed inflated, he kept wages, he pummeled businesses to keep wages up because he said the prosperity of America depends on high wages. So when you had deflation, when the banks were contracting their loans, that means they were withdrawing money from the system. So we had a contracting money supply. And so prices came down. That means wages had to go down for profit margins to occur. Instead, businesses were going bankrupt. The stock market lost 80%, 86% of its value. And there's an interesting chart that was in the economic textbook I used when I taught economics in 1985, 86. It showed the businesses that had the greatest drop in wages had the lowest unemployment, and the sectors of the economy that had the lowest drop in wages had the greatest unemployment. So they didn't allow the market to clear for wages and prices, and therefore you had an economic downturn turn into a calamity, which of course we know lasted a full decade because they didn't allow the free market to unwind the bubble of the 1920s.
Okay, and yes, Rothbard's book on the Great Depression is just absolutely fantastic. Highly recommended. Okay, let's go to the questions. First one is, wouldn't a refundable tax credit representing a saver's loss due to inflation be better than a capital loss deduction since losses are limited and they are not a dollar for dollar reduction in taxes?
Anything that reduces people's tax liability, I'm all for, whether it's a refundable tax credit. And the shocking thing, as you know, the maximum you can deduct in capital losses is $3,000. That has been in place for decades. That hasn't been indexed for inflation. So if that had been indexed to inflation, you should be able to deduct $50,000, $100,000 in capital losses instead of the $3,000 that that the IRS sets. So again, anything to reduce the tax liability of the American people, I'm all for. Since I wrote the book Tax Free 2000 in the mid 90s, that we should have a tax-free society. Anything that for tax credits that would do that, I'm all for.
Okay, let me just remind everybody that We're going to end at 8, but if you want to add questions, put them in the Q&A section. Okay, this question, isn't it a joke that Bernanke gets awarded for his study of the bankroll in the Great Depression, while as Fed chair in 2007 and later, while charged with bank oversight, he could not identify a real estate bubble?
This is shocking. I mean, there are two Fed economists. I don't have their names in front of me. They wrote a paper for the New York Fed that's saying there's no housing bubble just before the housing bubble burst. And it was incredible. I quote them in my book. I should point out the fallacy of their analysis. And this is what happens when you're so tied to statistics. They don't see the bigger picture, or they don't see the relationship between cheap money, economic activity, and unsustainable economic activity. And I think the great contribution of the Austrians is to show that easy money leads to unsustainable economic activity in all sectors. And now we're seeing it in retail. A lot of the retailers' stocks have plummeted in the last year because they feel that consumers are going to not show up at the store. Nike has excess inventory, as some of the department stores do. So we may see wholesale sales throughout this fourth quarter of 2022 because they have excess inventory. How do you get rid of excess inventory? You lower prices.
Okay, here's an interesting question for you. Respectfully, and with kudos to the independent charts, since Fred charts are new to a person like me, thank you, how can people be sure that the charts are accurate?
Well, how do we know elections are fair? I mean, this is where trust comes in. But the point is, you get a lot of anecdotal information. All you have to do is speak to business people, and they'll tell you exactly what's happening in the economy before the Fed collects the data or the Bureau of Labor Statistics collects data. Local real estate agents will tell you what's happening in their market regarding prices and inventory levels. Multiple listing service has data. I mean, the Fed does a fairly good job in collecting data. That's what they're really good at. They're not good at manipulating interest rates. So I think the numbers are pretty good. I've had a long conversation with Bob Wenzel about that. He said the people at the Bureau of Labor Statistics, and he said people at BLS read his work, and he said they are pretty good in collecting consumer price index data. But they're a problem with the CPI as well.
Okay, next one. Calling them business cycles implies that they are natural physical phenomena. Isn't it instead the case that these matters are due to actions taken by the Federal Reserve or the federal government?
Oh yeah, there's no question about it. I mean, we know that business men and women make mistakes. That's normal part of the market process. Think of the Edsel that Ford made in the 1950s. Think of all the other products that came into the marketplace and consumer demand was just not there. Look at movies. Look how many movies bomb at the box office because someone had an idea to make a movie for $50, $100 million and they generate $5 million in sales. So entrepreneurs always make mistakes. The question is, how do you get a systematic mistake in the economy? In other words, as Rothbard calls it, the cluster of entrepreneurial error. And that's because of, as Murphy pointed out, low interest rates cause business people to do things they otherwise would not do. So this is another example of moral hazard, that business people engage in activity they otherwise would not do if it weren't for cheap interest rates that the Fed, as Fleckenstein points out, shoves down the throat of the marketplace.
Okay, final question of the evening. This is an interesting one. Why is federal government spending included in the GDP when it is not really production?
That is a great question. In fact, you can make the case that the real GDP is a lot lower than it's portrayed because government spending, we know, is 30% when you add up all this government spending. And so Rothbard has this whole discussion in America's Great Depression. He calls it the private product remaining, which is what the real economy is producing as opposed to government spending. And that's why this is all entangled in the spending in the U.S. economy. So as what we need to do is, of course, downsize the federal government so we have a real economy based upon activities that people desire, as opposed to government spending, which shovels money to the special interests, whether they are the labor unions or industry or what have you, or foreign aid. Government spending, as we know, from a libertarian perspective and an economic perspective, is a dead weight on the economy. Of course, people benefit from it. In other words, if the government sends out tens of billions of dollars every month for Social Security, that money is going to be spent in the real economy, but is being taken workers who have to pay that Social Security tax. So you get all these interlocking relationships in the economy. And so you've called for it, I've called for letting young people get out of Social Security and Medicare and saving for themselves. But until that day comes, we just have to live with what we have and try to navigate this boom bust cycle the best we can.
Okay, which is subject of one of your books. Okay, well, we'll wrap things up
Absolutely.
with a comment from one of the viewers. He says, "Great slides. Thank you very much." And I'll add, that's a great presentation, Murray. Absolute great contribution to our conference here. And thank you very much. And next week, we've got Kevin
Thank you so
Dowd.
much.
Yeah, go ahead.
No, I just want to say this. I think these slides demonstrate that Austrian economics is not about theory, but there are, quote, practical applications of the, quote, theory to explaining how the world works.
Well, yeah, well, that's what drew me. One of the things that drew me to Austrian economics is that it deals with real life human beings that are acting in the marketplace. And
Absolutely.
So thank you for that excellent presentation. Next week, we've got Kevin Dowd, Professor of Finance and Economics at Durham University. Great presenter. I'm sure you're going to love his presentation. We've got in his bio that his work is heavily influenced by Austrian and public choice economics. An underlying theme of his work is the importance of institutional frameworks, respect for individual rights and the rule of law, and skepticism about policies that rely on the wisdom of policymakers or their ability to forecast the future. And I'm sure he'll be talking about the Federal Reserve in that context. So thank you for tuning in. Again, thanks for your support. And thank you, Murray, again. And we'll hope to see you all next week.
Thanks, Bump.